Hi everyone and welcome to this video. This time we will be discussing another income-oriented ETF, that's HDIF, Diversified Monthly Income ETF. So if you're watching this video, that's for sure that you're attracted to the dividend yield of this fund. It is kind of a new wave of covered call ETFs that offer really high distribution yield that's been attracting investors, especially the ones that are looking for income. So in this video, we will look at the opportunity that HDIF represents and whether it's suited based on the characteristics, the strategy being used, and the portfolio held within HDIF. So first of all, this is like a quick overview, like if you're in a hurry, so you just want to know the positive and the negative quickly at a high level. So you have for HDIF, the main positive obviously is the high distribution yield, which is I think above 10%. So the high monthly income is possible with this fund because of the option strategy being used, which this is what we why we call them covered call ETFs. They issue call options to gain premium. Um, and also this premium comes in addition to the dividends you're receiving. That's why the monthly distribution is really interesting at 10%. However, one thing to keep in mind, the distribution yield is not something fixed. It's not something that's going to stay forever. Historically, this market right now is a market that's favorable to covered call ETF, but in a different economic cycle, it might be completely different. This type of ETFs cannot guarantee a 10% yield all the time. So if we look at ETFs that's been in existence for over 5 or 10 years, especially covered call ones, especially on the U.S. market, you will notice that they're distribution yield has never been the same all the time. It kind of drops during certain type of markets and it improves in certain type of markets. Right now, they are in their ideal kind of market. That's why they're offering really high distribution yield. Just keep that in mind, that it's not a fixed yield that in a year or two, maybe HDIF will be paying much less than 10%. Another positive for HDIF is that it's diversified. It's actually what we call a fund of funds. So it includes a bunch of ETFs at the same time. So this is why it is diversified. You could see it here with all the bunch of funds that it includes. And what does it do is all these funds are actually covered call ETFs and they make up the HDIF. And all of them are from Harvest already. So you have the Harvest Tech Achiever, as the mention says, it will be technology stocks. You have Harvest Brand Leaders Plus Income, which is like the big companies that have a strong brand in the US and internationally. You have also the Harvest Canadian Equity Income Leaders ETF. So you get the point. They're trying to build a covered call ETF that will cover all kind of like various sectors. So you have the banking, travel and leisure, healthcare. So it includes various sectors. So this is a plus for you. That means that it's a diversified fund. You don't have to worry about diversification here. It's already diversified across sectors and across North America, Canada, and US. It includes also, like when you look at the portfolio for each of these funds, you will notice uh, that they include only like blue chip companies. So it's really large cap stocks that you will find here. And if we look here, you can actually on their website, you can check the stocks that are part of each one of them, and you will notice that are all large cap. So that's a positive also, like they're focusing only on stable companies with large capitalization. On the negative side, so you have the high MER. Now the MER is the management expense ratio. So it's what the fund manager is charging you to manage this fund. And of course, you want to avoid a high MER because it kind of it's eating up your profits. So in this case, the for HDIF, the latest published MER was 1.98%. So it's almost 2% that you are paying the manager to manage this portfolio. And that 2%, if you invested in a fund that has a much lower MER, then you will, of course, notice the difference. 2% over a long term can have a considerable impact on your overall return. But again, this is a covered call ETF, so you have to compare the MER with the similar covered call ETFs. And I think most of them are at the same level of MER. So it really depends on you. If you want to go for a covered call ETF, you have to keep in mind that usually their MER is high. When you go on their website, various covered call websites, they usually will publish only the expense ratio. Pay attention. It's the MER that you want to find, and the management expense ratio is the expense ratio plus the other fees. So it's the total fees, and not don't look just at the expense ratio. So this is one negative for HDIF, is that they are, in terms of overall, in terms of funds, they are in the high end MERs at 2%. They also have the covered call ETFs in general, that's not just in the case of HDIF, they tend to have a limited growth due to option strategy in place. Because the option strategy, it's a call option, so what you're doing is you're giving up on the potential growth for your portfolio. So let's say you own TD Bank, and TD Bank is trading as $80. What the manager would do is they will issue, in this case, in this type of fund, particularly HDIF, they use out of the money options. So they will tell the market, we're ready to sell TD Bank for $82, for example, in a month from now. So they are content with $2 profits, and they sell that option for like $1 or $1.50. So they're able to increase the yield and get some capital growth potential with the 82 minus $80. That being said, this is limiting your growth, because in case TD Bank went way up than just $82, then you're giving up on the potential growth of the stock. So this is something that comes back again and again with every covered call ETF. Some are really worse because they use the option strategy on their 100% or more than 50% of their portfolio. Some use aggressive options, not out of the money. They use sometimes at the money or even in the money. Those are even worse, because you're not just giving up on the potential, you're giving up on everything here when you use in the money. Uh, so um, so just keep in mind, it limits the growth. In the case of HDIF, it's not that bad because they're using it on 33% of the portfolio, and they're using out of the money. So it kind of it's not as worse as some of the covered call ETFs I saw, but it's still something that will limit your growth. It has moderate volatility. Something you have to keep in mind, though, the when you go to the covered call ETF website, they usually cite as an argument is that they are lower volatility than investing in those stocks directly. This is accurate, but it's still volatile. So if you are a conservative investors, stay away from covered call ETFs, because they will move up and down with the market, for sure. They would move less, obviously, than the stocks or the index they are tracking, but they still move. So you still have to be prepared for that. If you are super conservative, you don't want your investments to go up and down, for sure, a covered call ETF is not the one for you. Now, there is an additional risk because this ETF uses leverage to increase growth, and also the distribution yield. So just that, to keep in mind that they are using leverage to increase the growth, and also it comes with the risk. When you're using leverage, there is also more risk, more volatility that comes with it. So that's for the quick, brief summary of the positives and negatives for HDIF. In the link that I will provide in the description, you will find all the details about this fund. As I mentioned, it's a fund of funds, so it includes various sectors of the economy: healthcare, global brands, technology, utilities, US banks. So it's really diversified, and you're well served if you're interested in a covered call strategy. ETF, you want those yield, that income. So for sure, it will be a good option for you there. This is the ETFs that make up HDIF, and they are doing a quarterly portfolio reconstitution and rebalancing. the covered call strategy is applied at 33% of the equity of securities. This means 33% of your portfolio will use the strategy, will try to get you those premiums, will limit the growth, but the remainder 67% they're not using the covered call strategy. So if the market is doing well, you're going to catch some growth there on that 67% that they are not using the covered call strategy on. Can you lose money on a covered call ETF? Of course, because it moves like the index it's tracking. Here it's tracking a bunch of ETFs in various sectors. So if the underlying assets move up or down, the covered call ETFs if is impacted, even though that they have those options in place, but the option limits the volatility, but it doesn't eliminate volatility. So you can lose money because when you invest in a fund, you have to make sure you have an adequate yield, but also you have to have growth. Let's say you're getting 10% yield, dividend yield, that's good for you. But if you're losing on the stock more than 10%, then you're losing money overall. So it's something to keep in mind there. You have a balance, you need a balance between the distribution yield and the capital growth of the stock, the price of the stock, the price growth. And the overall covered call strategy, something to keep in mind in a bull market, when the market is doing well, they will lag in terms of performance because of the option strategy. But in all other types of market, like a modest bull market or a volatile market or a bear market, they were usually outperform the index because of the option strategy. Because as I mentioned earlier, the option strategy, you're way ahead every month telling the market, I'm willing to just take this much profit, please buy my option. So because you're doing this exercise on a monthly basis, if the market is going down, you are actually safe each month because each month you know what the price that you will be uh, um, gaining from the portfolio that you own. So overall, you will not capture the growth because it's lagging in terms of performance when the market is doing well. But when the market is not doing well, you might end up with a better performance than the index. Um, so for the summary, it comes with a bunch of benefits. It's for you if you are really into that income, but again, if you're looking also for growth, there is other options that offer a lower yield, but you will capture 100% of the growth. So just keep that in mind. There's other funds that are not covered call ETF. There are classic dividend ETFs, and if you're fine with the 4 or 5% that they offer, you will capture the growth and also you will get that dividend. With hdif, you're giving up on the dividend, you're giving up on the growth, but you want more income. So it depends on your um, priorities here and where you are in your financial life. Uh, so it's if you're conservative and you're just here for the yield, be aware, don't buy covered call ETFs because it moves with the market. You will lose money and capital money, or you will gain, but most of the time you will lose because it is a covered call ETF. At the end of the day, it's not there for growth. It's more for providing that yield. And if you are conservative, better just stick with classic dividend ETF for long term, or go back to more fixed income products. But the covered call ETF will sometimes disappoint you because you will get the high yield, but you will lose value on the price. In terms of price performance, will be really low, and it can kill the money that you're making in as an income. Usually, if you're retired already and you're fine with the volatility, HDIF is fine because you will get the income that you're seeking. And long-term covered call ETF will have a decent performance, not as good as a classic dividend ETF, but they will have a decent performance. Uh, Otherwise, if you're still building a portfolio, it's better just to stick with a regular dividend ETF. As I mentioned, the MER that's published on their website is 1.98%. There is also in the link, there will be a comparison between HDIF, HDIV. So I encourage you to read the article if you want to know more about these comparisons. And you have also all the other information. The dividend yield is 10.91%. So it's really a very high yield. It was created in February 11, 2022. And you could also check the performance in Yahoo Finance. Here it's dated as of September 23rd. So I hope this video helped you decide on HDIF. And if you have any questions, don't hesitate to write me in the comments section. Thank you.